And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined by Tim Seymour of Seymour Asset Management and Kevin O'Leary of O'Shares. Let's get started with the big story of the day, and that's China soaring after President Trump tweeted he would delay the deadline to increase tariffs. The FXI, that's a large-cap China ETF, now outperforming the S&P 500 this year, up more than 15%. Should you get in on this China rally, and what's the best way to play it? That's what we do here. Tim, you're the emerging markets expert. Are we off the lows? As we noted here, we're getting an outperformance from China. We haven't seen that in a while.
Yeah, well off the lows, Bob. And one of the things I know from my history in emerging markets, EM always tends to bottom first. So actually, this outperformance by the FXI is not just year to date. It's not just last week. It's actually since October you've actually seen the FXI outperforming the S&P, and I think there's reasons for that. Some of this is that this trade war caught China flat-footed, believe it or not. They were in a tightening mode. You had a dynamic here where I actually think that this was the worst possible time for this to come down on China. Good news for our politicians, I guess, tactically. But bottom line here is without tariffs, and China's actually now stimulating. There's been triple R cuts. They've actually begun to cut taxes. They've begun to pump money into the system, which we all know is a concern in the longer term. But in the short term, I actually think that Chinese stocks are not only cheap, but technically, you know, you have the Shanghai through the 200-day for the first time in over a year. You've got a lot of important technical factors that have their wind at the back.
We went from, do you buy this narrative? We went from a China slowdown 6 months ago. The Chinese are desperately trying to stimulate. There's way too much leverage. There's way too much debt in the economy. The retail investor in China got burned badly a couple of years ago. They didn't come back. Suddenly the narrative has changed around.
Well, they got beaten up pretty badly. You were down 48 to 58% on the typical Chinese name. So when wave past what anything did here, now it's coming and, you know, filling in the gap. The one thing I would say about this that's going to catch a lot of people off guard, if you didn't have an allocation through this whole volatility to emerging markets, specifically Asia, you're now going to underperform the global index by a material amount, probably 200 to 300 basis points if you're a money manager. Having no exposure to emerging markets is always a mistake over a 5-year period. That's what I found.
Okay.
So you have to take the pain on volatility.
We do want to point out this show is about how the ETF business works, and that all ETFs are created equal, particularly the Chinese ETFs that are out there. We can point out a couple of things here. The FXI is the large cap one is 50 Chinese stocks, but they're all Hong Kong listed stocks.
Yep.
So those are big industrial names and bank names.
State-owned enterprises.
That's right.
Et cetera.
SOEs, as we like to call them. The China ETF, the MSCI, the MCHI is the symbol there, has a broader mix. Hong Kong, mainland China stocks, and U.S. stocks like Alibaba. A lot of people don't understand. You own FXI, you don't own Alibaba, which trades right here. Behind me.
But
and
they are sort of correlated.
Differences.
The point is, if you want to own China, own them both, because frankly, they're not that different. And if you want to get every name, these are the two that captures them. But there's so many state-owned enterprises in there. That's funky chicken stuff. That's the problem.
And of course, companies that have significant exposure to China have generally rallied along with the Chinese market, if you look at it, particularly some of the chip names. So for example, Skyworks, Qorvo, Qualcomm, NVIDIA, all get more than 50% of their revenues in China, and I just picked the December 24th low there. You can see generally they're all outperforming. Qualcomm is the one exception there. So U.S. stocks are clearly responding to what's going on in China.
Yeah, look at the SMH. I mean, you know, we could make an argument again if we wanted to follow a path for really what was going on with the China negotiations. You've been following the SMH, which is again the ETF that tracks the semis, and the semis, which are cyclically most exposed to China. That was the trade that first broke down back in July, and arguably, in fact, semis are up about 26% off that Christmas Eve bottom, significantly outperforming the S&P. And so, you know, that to me is a tale where I don't think we've solved all the problems overnight with some relatively vague edict that came out. But I do think that the market overpriced all of these companies grinding to a halt.
There'll be more China shares on the market. MSCI likely is going to increase the China weighting a little bit later than this year. That's
and there's demand. And there's demand for that. If this truly is going to end up with a fair trade deal, including protection of intellectual property, this is going to benefit both sides of the equation. And they still have better GDP growth than we do. Whether you believe the government numbers or not, They're either 5 to 6.5%. They're in there somewhere, which is basically twice what we've got.
So, Tim, how do we play a trade deal? What do we do here?
Well, first of all, I think some of the industrial names that are exposed to China, but I like FXI because I think a lot of the Chinese banks are particularly cheap, and a lot of them look to be most vulnerable on the credit side in terms of a world where you're starving them from liquidity. You talked about Alibaba. First of all, one of the first stocks to break out and technically to actually overcome some of the resistance levels of last year was Alibaba. Remember, the Chinese mega cap tech names were some of the most popular trades in 2017. They were some of the worst trades in 2018. Yeah. I think you've actually reconciled a lot of the positioning there, and I think you've really outperformed. But valuation, to me, if you believe that China is getting at least not only this sentiment boost here, but that actually the government is reflating their economy a bit. Yeah. Look, Alibaba's not a trade stock, but it was treated like one.
But I love that. But is it? You just need to know when to play the turn, though. I mean, is it true as he says that they all turn around here at this point?
It's so hard to catch the knife with China. The volatility is twice what our market is, basically. And what I've learned is, as an investor, you just got to suck it up and take the pain. If you want to have 5, 10, 15% in the Asian markets, which you should, you've just got to get ready for volatility in your portfolio, and it hurts.
And this isn't a knife. I mean, again, everything you just said, Kevin, I love that. The point is, you've got the opposite going on. You need to kind of ride this momentum. That's how you want to play it.
I have a friend who owns a Chinese mainland fund, and what's amazing to me is he goes there all the time. He says the retail investor is just not as sophisticated. They're a much smaller part of the stock-owning population that's active, a retail investor, and they get spooked easily. They're just not as sophisticated. So you're right. He said you have to take the fact that you're going to get crazy volatility, and now look, it's coming back a little bit. We got to move on here, guys. Here, stocks have soared off of the lows. Of course, another area of the market is quietly on a tear, and that's high yield. The HYG, the corporate bond ETF, within a hair of its 52-week high. For more on the bond market, let's bring in Chris Concannon. He's the president and COO of Market Access. This is a fixed income electronic platform. Chris, welcome. You just became the COO and president a short while ago. Explain what Market Access does. It's all about essentially bringing electronic trading to the bond market, which happened down here 20 years ago.
It did change down here, and thanks for having me, Bob. Sure. Market Access is truly a fintech company. It has really changed and altered the way fixed income is traded today. A fully electronic market on Market Access. Last year in 2018, we traded 1.7 trillion of fixed income securities. So it's such a dramatic change to a market that is absolutely enormous.
And the market seems to like it. It hit an historic high just last week. So somebody's obviously buying into that. I was surprised only 30% of all bond trading is done electronically. Only 30%. Now here, of course, obviously it's close to 100% essentially in the equities market. Why is the bond market lagged so far behind in terms of electronic trading? Why is it still largely over the counter?
Well, there's a lot of reasons. One is the number of instruments in the market. It's a much larger market. It's somewhere around 3 times the size of the equity market. So when you have that many instruments, you really are dependent on a dealer-driven market. But over time, it's really, because of Market Access, it's delivered a centralized pricing market to the individual investor and to institutional investors largely.
And I want to emphasize, you see the screen here, these are big funds out there. The AGG, which is the largest bond fund out there, almost $60 billion. Vanguard Total Bond, investment grade corporate, that's the biggest corporate bond ETF. The TIPS market's also big. And we mentioned high yield, despite all of the anxiety about the, a downturn in the economy, that's been holding up very well on top of that. Where do we go from here? What is your mission? Do you think 5 years from now, 60% of the bond market will be electronic?
I do think we have both a growing bond market, so the turnover of the market is actually increasing year over year. Part of that is the efficiency of the market. When you deliver electronic trading to any market, including the US equity market, the overall turnover, the daily turnover grows, and we're experiencing that now. So I do believe the close to 30% is electronic today. We should be closing in on 50% of the market in the coming years.
Kevin, do you see opportunities in buying into the bond market?
I do, because I think the ETF market around credit and bonds is 5 years behind that of the structures and the products that are brought out in equities. I can't find product that fits many conservative mandates in bond ETFs. For example, if I don't want market cap weighted, particularly in credit markets like J&K, or, I can't own a C credit. That's the bottom 18% of J&K. Why hasn't that been solved for me? Why isn't there something with duration? I can buy 2-year, 3-year, 4-year, 5-year duration, so I can blend ETFs together to get a duration that I'm comfortable with in a mandate. None of that exists yet in the credit and bond markets, and that is an issue. And most of the manufacturers say there's not enough liquidity to do that because of all of the regulation. The bonds don't rely, or are not sitting on the money center banks anymore. They're off in hedge fund land. And that's a problem with over-regulating a market. That is why we don't get innovation, in my view, in the credit market with ETF indexes, because it's an over-regulated market that's not liquid enough.
Is it solvable, what his concern?
Some of it's being solved by alternative liquidity providers. We're seeing an onslaught of the same market makers that exist in this equity market. They've been big supporters of the fixed income ETF market, and they're transforming the fixed income underlying market. And they're one of the reasons why the electronic market portion of the fixed income market is growing. They're driving that change.
Yeah. Tim, your thoughts on
that? Well, my question, Chris, would be, in December, look at the HYG, look at the credit markets, look at the junk bond market, and look at, on some level, you could make an argument that the equity market was pushing around the credit markets. Or I'd be curious to get your take on what was a massive drawdown in the HYG or the JNK, the two big junk bond ETFs. And ultimately, this is probably equity guys trying to hedge off credit risk that they don't know a whole lot about. But to what extent do you see that these ETFs are pushing around credit markets? Because everyone I was talking to who was trading high yield at a desk with a pad and buying and selling was not seeing a lot trading. Things were just getting marked down. And you can argue the ETF market exacerbated that.
Well, we actually saw on our platform record volumes in December. Because of that drawdown in the ETF market, the market makers that support those ETFs were playing into the fixed income market quite heavily. Right. And we didn't see a problem in the trading of the market. The spread stayed tight. The market between the ETF and the underlying fixed income stayed fairly tight. So it was a very attractive disruption to the market.
Well, how do you feel about active traded bonds that are out there? For example, MINT, which is the PIMCO ETF. That's actually the biggest actively traded ETF that's out there, MINT. It's attracted a lot of money. Is there the same debate in active bond management as there is in active stock management? That is, that the active managers do not outperform on any regular basis?
I think it's hard to say because, when you look at the evolution of the indexes in the fixed income space, I think there's a lot more we can do in that space in terms of picking the right liquidity, the right instruments. So the active managed ETF, whether it's equities or fixed income, I think there's true application in both.
Yeah. I'd love to go on here. I want to move on and talk about a very interesting subject here. We're going to stick with bonds, and we'll do a little myth busting. This is something that's always gets people going here. There's a common misconception out there that volatility in bonds could spark contagion in the underlying market. So, Chris, you know the idea. The ETF haters out there, they think there's going to be some giant contagion because you've got some funds that invest in somewhat thinly traded bonds. Floating rate bonds, for example, and that if there's ever a period where you are selling those bonds, those ETFs, and you need to sell the underlying, there's not sufficient liquidity, and somehow this could cause a mess. How do you address that?
Well, I think we've been tested, right? There are very active fixed income ETFs in the market today, and we've seen some disruption in our equity markets that have bled over into the fixed income market. October of 2018 is a perfect example. Big drawdowns across all TFs, both equities and fixed income. And we didn't see a dislocation in the market, the underlying market. So I do think the myth is out there. Maybe we haven't tested it fully. We haven't seen the true black swan. But we've had some pretty harsh tests of the system as it stands.
That's the way I feel. Kevin, you own an ETF family. Do you have concerns about underlying liquidity of ETFs that are out there?
No, but I don't do a lot of small cap ETFs. I'm always worried that if someone wants to put 100 million, 200 million in, I don't want to move it more than a penny. And if the underlying issue is large cap, domestic, S&P 500 companies, you don't have that problem. Where you have that problem is in very eclectic credit markets of a single C, a double C credit. there's no liquidity. That trades by appointment, and that's why I think the fixed income ETF market has a ways to go. I'd like to see an ETF that actually has actively managed rules that say liquidity is one of the metrics by which you decide what the underlyings are.
So can electronic trading deal with this problem where you have to trade by appointment? Is there any way to increase liquidity using electronic trading?
Well, what's great about electronic trading, it creates data. And the data that we have now actually shows what the liquidity in the market is. And so we are putting out data daily in real time where you can look at what the liquidity in a given bond instrument is. And these applies to global bonds. So it's actually a way that we can create some smart indexing based on the liquidity in the underlying.
My problem with this whole argument, Tim, is we had this crisis. We've had several crises in the last several years. What do you want in the fourth quarter? If that wasn't a crisis in December, my heavens, if that market wasn't tested then and we got out of it, is there something wrong with that theory, though? Is there something we're missing?
Look, less liquid markets are going to gap out. And I'm an emerging markets guy. And I used to call this the ETFization of my markets, because if I'm trading Brazil and I've got second-tier Brazilian stocks and a billion market cap, but suddenly people are throwing around the EWZ as a hedge overall for their portfolio, these stocks that are 50 bips in this portfolio are going to get thrown around. The same thing goes on in credit. So I don't think you can replicate the underlying dynamics. If a market's a liquid, it's a liquid. And I think that's where the confusion lies. The ETF's not going to solve that problem.
That's exactly my point. If people want to sell, they're going to sell. They'll find an ETF to do it. They'll find a way to get on the floor. They'll throw a rock at someone, say, take whatever I've got. If people
rocks at Kevin.
want to sell, they're going to find a way to sell. And an ETF is a vehicle. Mutual fund is a vehicle. Yeah. Brokers on the floor are different vehicles. Don't get me started. We'll go crazy. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Chris and Kevin and Tim for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.